Welcome back to Halftime Report. Well, as promised, we have the management of SKF India. It was a pretty good set of numbers, actually, if you look at it. But the margins perhaps didn't expand as much as what the street was expecting. Manish Bhatnagar, the managing director of SKF India, is joining us now to talk about the way forward, what the growth opportunities are looking like. Manish, thanks a lot for joining in. I want to start by asking you about what happened in Q4 because there were various factors at play, whether it's inflationary pressures, supply chain has now normalized, there's manufacturing costs as well. Can you tell us what is the way forward in terms of profitability? What are you looking at in terms of growth as well in FY24?
Yeah, so we had a pretty good set of numbers for the quarter, you're right, but more importantly also for the year. We normally don't look at quarterly results a lot. We look at full year numbers, and it's been a pretty good set of numbers. Going forward, we see, you're right, we see supply chains normalizing, but more importantly for us, we also see localization of supply chains moving ahead at a very, very rapid pace. If you recall, during COVID times, a lot of us were looking at how best can we localize supply chains. And bearings at some level is a very simple product, but also a very complex product. It's basically 4 or 5 components assembled together, but each of those components have very, very high dimensional accuracy needed. So it can become fairly complex. So localizing our supply chains just takes a little bit more time than maybe other companies do, but all that work is now paying off. So we see next year to be a really good year in terms of profitability for us, and of course, growth numbers coming in line with our strategy.
Okay, so when you say localizing of your supply chain, I'm guessing it also brings down your cost because just trying to understand what this means for margins. This quarter, your margins were under pressure. Perhaps it was also because of an inferior product mix. But compared to the 17% last quarter, this quarter fell to about 15%. So when you say localization of the supply chain, will it help you in terms of reducing costs? And what does this mean for your margins in FY24?
Yeah, our margins are really a mix of really a function of the mix between industrial and automotive portfolios. As you know, we are about half in both those segments. Automotive is almost fully localized in terms of manufacturing. Industrial is about 35% localized in terms of manufacturing. So the more we sell of industrial, the more is our traded mix, and therefore margins come under pressure. Last quarter, automotive did not do as well as industrial did, and therefore the margins were a little compressed in the last quarter. Going forward, we see automotive also picking up, and you're right, the more we localize supply chains, the more we localize manufacturing, the better it is for our margins locally.
Right. So let's talk about a couple of factors then. The last time you joined us, you did indicate that you were running into some sort of capacity headwinds and you were looking to expand capacity. Now we see that you have added some capacity. So wanted to understand what sort of capacity headroom do you have right now to grow? And if there is less, then are you looking to enhance it further? That's point number one. And secondly, you did grow about 16% in revenue last year. Even if you assume that this sustains next year, what will that be in terms of your industrial and automotive businesses? You have 2 businesses like you just said. How will these 2 verticals grow separately from each other?
First of all, you have a very good memory. I did say that we will expand investments and we will add more manufacturing headroom. We have done that, but it's a good problem to have that our revenues have grown faster than our manufacturing capacity added. So as I stand right now, we are again looking at adding more investments. And again, most of our investments will come on the industrial side for the reason I just mentioned. We want to minimize our traded mix in our products, and that's mainly industrial. So the more we localize there, the more our industrial becomes localized and better our margins is. So we are now looking at more investments now on the industrial capacity side. So that's the first part of your question. The second part, what will the 2 segments look like going forward? You're right, 16% this quarter. Going forward, we expect industrial to be a lot more in terms of growth than automotive will be. Industrial in general is doing far, far better than automotive. It's far less cyclical because we are so diversified. Not one industrial segment is more than 7 or 8% of our total revenue. That really helps us if something goes down, something else goes up, etc. So it's far less cyclical. And if we can get our investments in order to increase manufacturing, we expect industrial to grow much faster.
Let's help us understand the entire piece then. How will your revenues look? Currently, it's half automotive, half industrial. Most of automotive is localized. Only 35% of the industrial business is localized. Going forward, industrial goes faster. So question one is, how much will that be in your revenue? Secondly, in that, how much of that will be localized? And because industrial margins are lower, with this revenue mix, how will your overall sustainable margins look like?
Well, industrial margins are lower today because it's not fully localized. So, of course, if we grow industrial as we want to grow, we also need to localize industrial production, manufacturing, supply chains in country. But to answer your question, today it's 50-50. Globally, it's about 70-30 for us, so 70% industrial, 30% automotive. And I expect over time, India too will fall in line with that global number. Of course, it won't become 70% overnight. It's a gradual journey. But in the steady state business of the next 5 or 10 years, industrial will inch towards a global average. That's obvious. And sorry, what was the second part of the question?
What happens to the margins then with increasing localization? Do we structurally see margins move towards 18-20%?
Right. So today industrial is about 35% localized. If we move industrial to about 70% localized, margins will start moving up, certainly way higher than where we are today.
Okay, margins will start moving up. Just wanted to understand this additional shares that you acquired in CleanMax Tire. Can you tell us a little bit about that? What is the rationale behind it? What is the impact that you see? And any more, inorganic expansion plans that you're looking at in the near future?
Yeah, the investment you talked about is a very, very small investment. I know it makes the headlines, but it's really not that material to us. It's not in our business line. It's more in terms of where we source our renewable energy from. So it's a solar farm that we invested in to make sure we get more green in terms of our supply of energy. So it's not a big thing to talk about. In terms of the larger question is, are we looking at inorganic plays? We always are. And we always are. In India, we are always evaluating companies, suppliers, etc. So far, we have not found a company yet that will go past the due diligence stage. But we're always cultivating companies, talking to many promoters. We'll see where it lands us in the future.
Right, and Manish, quickly before we let you go, I wanted your thoughts on the railway business. That was about mid-single digits in terms of contribution, rather high single digits in terms of contribution. How has that grown? You expected it to increase a lot more once the dedicated freight corridor came by. So has that happened? And dividend, you haven't paid dividend in a while. Just wanted to know.
Well, I don't know what you mean by we haven't paid dividend in a while. We just paid a very high dividend this year, 400%. It was 145% last year, so it's 3 times that now.
All right, and the railway business?
The railways business is about, you're right, it's a single digit right now. It will go up to about maybe low double digits, and that's linked mainly, you're correct, linked to the freight expansion. The DFC is now finally taking shape. As we spoke last time, many of our bearings are now approved by the railways. We'll see those bearings get fitted into the new wagon builds. We'll also see the aftermarket picking up for railways. So a combination of both these factors, we'll see railways growing faster than perhaps the rest of the industrial business.
Okay. All right. Well, thanks a lot for stopping by and speaking to CNBC TV 18. Appreciate your thoughts. That's the word coming in from SKF India. Let's slip into a quick break. On the other side, D. Ramareddy, the MD of Balaji Amines, will be joining in to discuss the leadership changes. Do stay tuned in.